Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and today we're going to be talking about our economic growth. We have the Q1 numbers with us now, and we have what the World Bank has projected for the year ahead. They've made some recommendations, some things that India might need to fix. But to discuss all of that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, we know that the GDP growth in Q1 came in at 6.7%, even though the RBI had predicted, I think, 7.1%
Correct.
for the first quarter. But how does this growth compare to Q1 of last year and even the fourth quarter of last year?
Yeah, so if we compare with Q1 of last year, there is a sharp deceleration because in Q1 of last year, growth came in at 8.2%. And even if we compare with the last quarter, which is the March quarter, growth has slowed considerably because growth in Q4 was 7.8% and now it's 6.7%. But it was on expected lines because April to June quarter was the election quarter where it was expected that government spending would slow down, government capex would slow down, so that would have some bearing on growth. So it was on expected lines, and also agriculture was also expected to slow down a bit because of excessive heat. So
The heat waves.
heat waves. So it was on expected lines, but yes, it is a sharp deceleration from the previous quarter as well as the last year same quarter.
Same quarter. But despite all of this, there are some positive signs that came out of the data, right?
Yeah.
There was a recovery in consumption
Yes.
and stronger investment activity. So could you tell us a little more about that?
Yeah, so that's what is very encouraging, that even though the headline number looks quite weak at 6.7%, but if we look at the gross value added, which is a more representative measure of economic activity, it came in at 6.8%, and there is an increase from the previous quarter, that is Q4.
Right.
So if you look at Q4 growth, the GVA was, the gross value added growth was 6.3%, now it's 6.8%. So the internal fundamentals are much more favorable, and as you rightly said, one of the key driver of growth from the expenditure side or from the spending side has been the sharp rebound in consumption.
Right.
We've been talking about this, that one of the pain points of the GDP data was that consumption had slowed considerably in the last financial year, even though the overall growth rate was 8% plus, but consumption, which accounts for 60% of GDP, grew at only 4%.
Yeah.
But here what we are seeing in the first quarter is that even though the headline growth came in at 6.7%, but consumption came in at 7.4%. So there is a revival, and we spoke about in our previous discussion we had on expectation about GDP that
Correct.
the rural demand is likely to see a rebound, and that's what has driven the revival in consumption. Because if we look at various high frequency indicators capturing rural demand, like two-wheeler sales, tractor sales, also the demand for work under Mahatma Gandhi Rural Employment Guarantee Program,
Right.
that showed a decline, and tractor sales and two-wheeler sales showed an uptick. So it was expected that rural demand would show a pickup, and that has manifested in higher encouraging consumption numbers, and that's also reflected in higher share of GDP as a share of the consumption as a share of GDP has now plowed back to, gone back to 60%. Previous quarter it was 57%. So
Right.
consumption is one very good news. The only the point that needs to be noted here is that it's mostly rural demand that has driven consumption.
I was going to ask that.
Yeah.
So rural demand has picked up, and that's great news.
Yeah.
But the thing is that rural demand also is largely pegged to things like the monsoon,
Correct,
which
yes.
are erratic.
Yeah.
But on the other side, so far,
Yeah.
urban consumption has been what has been driving a lot of the
Correct,
growth.
correct.
But this quarter's data shows that urban consumption has slowed. So,
Yeah.
isn't that quite a concern?
It is a concern because from the consumption year-on-year growth, we can't make out whether it's rural or urban. But if we look at the various high frequency occupancy indicators, we can infer that it's the urban demand that has been showing some signs of slackness in the June quarter. Also, very importantly, if we look at the consumer confidence survey, the RBI's consumer confidence survey, it has been showing a moderation, and that is capturing the pulse of urban consumers. So that is one point, and the other is also the various urban demand indicators showing mixed picture. For example, auto sales has been showing a decline. Maybe some part of it is linked to election related uncertainty and heat wave, but yes, there is a sluggishness seen in urban demand, some of the indicators. Also, but if we look at FMCG, the fast moving consumer goods, there we are seeing a pickup in most of the indicators. So there is a mixed picture here, but yes, urban demand is something that needs to be watched out, because till now we have seen that it's the urban demand that has driven, and we've been talking about the K-shaped growth in consumption. But now it's another form of K-shape where rural demand has risen because of better prospects of monsoon, improvement in rural incomes and so on, and moderation in inflation. But urban demand is something that has to pick up so that there is a sustained pickup in consumption.
Of course, I mean, you need both the engines to be firing.
And also the other, you talked about private investment.
Yes.
Yes. So if we look at the other component of demand, which is the gross fixed capital formation, that again grew by 7.5%, which was a positive surprise, because as we spoke, that government capital expenditure has contracted. If we look at the fiscal data from the CGA, the Controller General of Account, it shows that government capex contracted by 35%.
Because of the model code of conduct.
Model code of conduct.
Right.
The state's capex also contracted by almost 20%. So at a time when government capex, which has been the key driver of capital formation till now, that has contracted, and even then we see a 7.5% growth in capital formation. That is a very welcome sign, and
that means
and
the
that
private
shows
sector.
Private sector. It shows that the non-government investment has started showing signs of pickup. When we say non-government, it means the government, the household sector and the private sector. Now, household sector investment has been growing strong because of investment we have seen in real estate. The real estate purchases have remained strong over the last couple of quarters, but we are also seeing some signs of pickup in private investment. If we see, say, the credit by large industries, because if we see credit by large industries, till now it was languishing, and credit growth was being driven by credit to services and retail credit. But in the last quarter, we saw that there was a big increase in credit to industries, not only on year-on-year change, but also on quarter-on-quarter change. So sequentially, there is a jump, which shows that they are sensing some investment demand. They are sensing demand. That's why they are borrowing. So there is credit to large industries is one indicator, and the other is RBI's capacity utilization survey, which shows that for the Jan-March quarter, the capacity utilization inched up above the 75% mark. So it is now crossed 76%, which is again an encouraging sign. There are also, if we look at investment intentions in a number of projects, we are seeing. So private investment is gaining traction. There are these early signs. Only thing we need to see is that it should become more broad-based in the coming quarter. But yes, private investment, household investment drove capital formation in the April to June quarter.
Fantastic. I mean, that's actually very good news to hear. But now let's look at each of the three main categories in the economy, that's agriculture, manufacturing and services. Let's start with agriculture. You mentioned in brief that the heat waves led to a slowdown.
Right.
So is that likely to now reverse?
So if we look at agricultural growth performance, it came at 2%. Now, as compared to the previous quarter, it's a recovery, because in the March quarter, growth was only 0.6%. But as compared to the year ago quarter, this growth is a slowdown, because in the June quarter of last year, agriculture posted a growth of 3.7%. So there are some, what happened in the June quarter was excessive heat, Uneven rains impacted production, but at the same time, Rabi harvest was good. Wheat production has been better, so that lifted growth in agriculture. But going forward, it is expected that with better monsoons and rains in August and September, growth would be stronger in the coming quarters. Only thing again, what we have to see is that there are some states which are still rain deficient, like Punjab and Haryana. They are still
It's been uneven
rain even now. So
Yeah.
that is something that if it becomes more broad based, then we should see better prospects of agricultural performance, and that would have impact on rural incomes and so on.
Right, and now coming to the manufacturing sector and the overall secondary sector,
Right, yeah.
if I remember right, I think the manufacturing sector did better in
Yeah.
Q1.
Yeah, manufacturing sector, again, as we spoke in our previous discussion, that because of the moderation in profitability,
Yeah.
because of higher input cost pressures, there was this expectation that manufacturing GVA would slow down. So it has slowed down, but not that much. So even now, manufacturing GVA was 7%, even though IIP was slightly subdued, and profitability was not very high because of high input costs. So manufacturing came in at 7%, but what showed very healthy growth was construction sector, which showed a growth of more than 10%.
And it's been doing strongly for
It's
a
been
long
doing-
time now.
Yes, and that is something to be linked with the robust demand in the real estate sector.
Right.
We've seen boom in the real estate sector happening. So we can corroborate the demand in the real estate sector with the strong performance of the construction sector. Electricity is again another sector that has done well, and that was again expected because of heat wave
Yeah.
production. Electricity demand for electricity was higher, so electricity again posted more than 10% growth. So overall, secondary sector comprising of manufacturing, construction and electricity overall did well at more than 8%. So it came in at 8.4%.
Fantastic. And but now on the flip side, the services sector, which so
Right.
far have been doing well,
Yeah.
they came in slower than last year.
Yeah, services now, in services there are three main segments. One is your trade, hotel, transport, communication. The other is the finance, insurance, real estate, and the third is public administration, defense and other services. Now, if we look at the share of these three broad sectors within the services sector, the biggest component is of finance, real estate, insurance sector, which is almost more than half. And it slowed down. There is some element of base effect here, because in the Q1 of last year, finance, real estate grew at more than 12%. And that
Correct.
was due to a strong growth in credit as well as deposits. But now we are seeing some weakness, some slowdown, or better word to use is normalization of credit and deposit growth. So that has resulted in some slowdown in finance, real estate, GVA. But the main cause of concern is actually the trade, hotel, transport, communication, where growth came in at just 5.7%. And that is the informal, mostly it is informal and it is labor intensive. So
Right.
if there is a slowdown there, it doesn't bode well for the growth prospects of the economy. So this is something that needs to pick up. And even if we look at in absolute terms, we see that the gross value addition in absolute terms hasn't picked up beyond the pre-COVID level. So we are still in the same range as we were in post-COVID. There is some improvement, and again it slides back.
This
So
is the trade, transport,
trade,
hotels.
transport, hotel,
Right.
communication part. So that is something which has not yet it has not surpassed the pre-COVID level, and that needs to be seen, so that, because it's again very important part of this overall services sector. So it needs to pick up. There is some again base effect, because in the Q1 of last year, growth was around 9.7%. There is some element of base effect, but overall
But if in the absolute terms it's more or less the same as pre-COVID levels, then
yes.
base effect and all
Yeah,
can only explain so much.
So much, yeah. So overall, that is something that needs to pick up over the on the coming quarters.
Okay, so now coming to the year ahead, I had mentioned at the start that the World Bank had just come out with its India Development Update. In that, they focused on trade,
Right.
and they made some pretty categorical statements showing with data that basically while India is growing well in terms of the high value added exports, the employment linked sectors, things like apparels, textiles,
Right.
footwear, there we've actually contracted and we've lost a lot of market share to countries like Bangladesh,
Right.
Vietnam. So now going ahead, is there a need for us to realign our export focus, try to focus more on these employment generation
Yeah, that's
sectors?
very important because the key question now being asked is that okay, we had 6.7% growth in Q1. Can we have a 7% plus growth in the medium term? So that's
Right.
the question being asked, and so that would require some re-engineering of our trade policy, because trade is an important constituent of the total of our growth story. And the World Bank report rightly points out that as a share of GDP, our exports of goods and services have not risen, though in absolute terms we have seen, but as a share of GDP we are not seeing a perceptible rise, and our
Right.
share in world trade is also not increasing to a material extent. And the main recommendation being made is that our exports are being concentrated mostly in capital intensive sectors. And given that we have this employment problem, we need to ensure that our exports get diversified in terms
Right.
of product composition and also in terms of finding newer markets, so that we are able to reach the goal of $1 trillion of exports by 2030, which is one of the medium term goal articulated by the government, and which is a very important goal for achieving a medium term growth of 7% plus growth. So exports is a very important part of the growth story. So we need to ensure that exports become more diversified and they become more labor intensive, because employment intensity of exports seem to be falling, which needs to be reversed. And as you rightly pointed out, focus has to be on labor intensive exports like textile, garments, leather, footwear and so on, where we are losing market share. So in order to strengthen the employment and export relationship, it is important that we focus now more on labor intensive exports. And with China losing ground in some of these sectors, this is an opportune time where we can take advantage of the opportunity, because the labor advantage, the low wage advantage in China is now losing ground. So it is an opportune time for India to realign its trade policy and diversify its export basket.
So now these changes that you're recommending, it's unlikely that we can put them in place, say, over the next 3 quarters.
Yeah, correct.
So then, now that Q1 came in at 6.7, how likely is it that we will meet the 7% estimate that everybody seems to have for the year?
Yeah, so if we look at various estimates, the World Bank recently has revised upwards its growth projection from 6.6 to 7% for this financial year. RBI projects 7.2%.
I think
Moody's
IMF also says 7%.
7%. Moody's have also revised it to 7%. So the consensus is around 7%. But to reach 7%, given that we had a weak Q1, even though internal fundamentals were stronger, we need to see that urban consumption picks up, because as you also pointed out, that rural consumption is dependent upon monsoons. It is dependent upon having a lower food inflation again, which will boost rural incomes and so on. So we need to ensure that urban demand also picks up in a significant manner, and the green shoots of recovery that we are seeing in private investment, that should continue, because it is expected that government capex will come in a big way in the subsequent quarters, because
Right.
it did not in the first quarter. We are already seeing that the National Infrastructure Fund is going to raise some $1 billion to finance infrastructure projects in this year. So government capex will definitely be there, but going forward, if the private investment recovery that we've seen in the first quarter, if it continues, then we will see durable growth in investment overall. So that is one. Second is urban consumption needs to pick up, and third, very important, is that the services sector also need to get more broad based. The labor intensive services need to pick up, and exports Exports supported growth in first quarter because exports we saw an 8.7% growth. We should see that exports contribution remains positive and it should not turn a drag on growth.
Right.
So those are some of the things that will ensure that we are able to achieve a 7% plus growth rate in the year. And then of course there are these medium term recommendations that will ensure that we are able to achieve a 7% growth on a medium term basis.
Right. So there you go. Now I can't encapsulate that better than she has. She's outlined all of the strengths, all of the concerns. But basically what we have is that the Q1 data shows a mixed bag. There are some positives, things that didn't happen before, which is that the consumption, especially rural consumption, has picked up again, which is great news. Private investment seems to be coming in strongly or relatively strongly, which is again great news. But we can't take for granted that we are just going to hit the 7% growth number this year just because everybody is predicting it. There are several things that still need to fall into place, things that the government needs to do, things that the private sector needs to do for all of this to come together and for us to hit 7%. But on that note, that's all we have for you. Thank you so much for watching.